Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thank you for joining us on our webinar focusing on investing one-on-one. We will be with you in just a moment. We are waiting for a few more participants to join us. All right, thank you for your patience. We are going to go ahead and get started. So thank you for joining us today. We appreciate you guys giving us your time, and we hope you find the presentation informative. I'm Manny Frangidakis. I'm a financial advisor, and I'm one of the co-founders and principals of 12 Points. So what we're going to be talking about today is just investing 101 basics, going over the definitions, terms, and phrases that folks may be unfamiliar with and get them better educated. So what we're talking about here, and most importantly, and what's front and center in most people's minds, is stocks. So what are stocks, what are shares, and what are equities? So it's part ownership of a publicly traded company. Essentially, you're buying a corporation stock for future cash flows. And for the most part, you're doing it because you think that the company has high growth expectations and there is a potential divergence between the stock price and the future stock price. The corporations will issue and sell stock to raise funds by giving stock owners a portion of their equity or value of the company. As the value of the company goes up, so does the value of your stock. Some companies pay dividends. They're mostly known as value-oriented companies. These are periodic payments to shareholders, and the dividend rate is essentially how much a company pays out in dividends relative to its stock price. Stocks, a lot of the time you'll hear about stock splits. There was a number of them this year, including Apple and a few others. So what happens in a stock split? Companies increase the number of shares offered to the public. So the price of each share goes down, the number of shares stockholders own goes up, but there's no change in the underlying value of the company or what investors own in shares. It's essentially just divvying up the pie. You'll see the pizza down below. It's the same graphic, right? So whether you cut it into 8 slices or 4 slices, it's still one large pie. So it just changes in terms of how many outstanding shares there are, but the value does not decrease. So stocks, there's 2 metrics that we use to take a look at stocks to derive valuation metrics. So you have earnings per share, which is a company's net profit divided by the number of common shares it has outstanding, how much money a company makes for each share, and one way to see how profitable and therefore attractive a company is for investors. Price to earnings ratio. So it relates a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued or investors are expecting higher growth rates in the future. It does change based off industry. So you'll see, cyclicals and industrials have lower PE valuation than technology companies. Think your Googles, your Facebooks, your FANGs. And then from there, PE is a really good metric in terms of understanding the value of a company and in terms of whether it's overpriced or underpriced. So it's actually Warren Buffett's favorite metric. Usually, what is considered good value is buying anything between an 11 PE ratio. That is usually looked upon as cheap. And anything north of your 20s to 25s are usually fairly expensive. But again, it depends on the growth rate of the company. Right now, the PE for the actual market as a whole is closer to 36. So we do believe we're in like the top percent in terms of value, 99 percentile in terms of valuations. So other types of investments, you'll hear about bonds and fixed income investments. So what is a bond? It's a unit of a corporate or government debt issued by the organization and securitized as a tradable asset. Bonds pay a fixed interest rate, also known as a coupon, to debt holders. They're considered safer investments than stocks, but typically have smaller returns. I think that is up for debate right now on whether the stock market is safer than the bond market. They're both at all-time highs. And bond prices are inversely correlated with interest rates. And what we know to be true is that interest rates are at historic lows and have been that way for a number of years. But in theory, they really only have one way to go up, only one way to go, and that is up. So in the way that would work is if interest rates go up, bond prices go down. So after a 40-year bull market in bonds, we could potentially be facing a bear market in bonds. And one of the things that is being considered and as a concern across investors' mind today is, could you have tops in both the bond market and stock market? And could they trade in correlation, which is usually not the norm? Diversification, you'll hear this a lot. And what does it mean to diversify your portfolio? Most people think that you can diversify across just a number of different stocks, and that's diversity, but it's really not. You really want to have multiple buckets, and you'll see the graphic below where you see stocks, commodities, bonds, and cash. You want to make sure the way to look at diversification is when you're checking your account, whether it's 401k or otherwise, that things aren't trading in the same direction. You shouldn't have everything be green one day and everything red one day. You should have different things working on different days based off of the investment environment. And that is really how you know you have true diversification. And why should you have diversification? Well, you're containing a mix of asset types in an attempt at limiting exposure to risk. Industries and similar asset types often move together. So you'll see technology move together, you'll see oil and gas move together, you'll see the metals move together, you'll see commodities in some regard move together. Right now, they're a little bit debased because you have a run up in energy, but you have the metals lagging. You just had a correction in the lumber prices. So they are moving in different directions, but you do want to make sure that you're diversified, because at the end of the day, what's going to protect you from market corrections is not having all your eggs in one basket. As you can see from the graphic, those eggs are all split across. So your bonds and stocks should move inversely from each other. Commodities are a great opportunity to right now, especially as we see inflation creeping up. So something that has, that is going to work well in inflationary environments is going to be important. We just left a 12-year period with very, very low inflation. And I think that we could be, what worked over the last 10 or 12 years probably doesn't work for the next decade. So making sure you're diversified is going to extremely help in terms of protecting your portfolios. And cash is a diversifier. Cash, in our opinion, is the ability to buy something cheaper down the road. We do think that opportunities arise and that there should be some volatility towards the end of this year with more opportunities that arise. So making sure that you have cash and the ability to buy something down the road is also important. Power of compounding. This is one of my favorite charts, and those of you who have sat in our 401k group sessions have seen this in a different graphic, but it really just states the earlier you start, the better off you are. So in addition to earning returns on the money you invest, you also earn returns on those returns at the end of every compounding period. So what this graphic is showing you is that essentially at age 21, if you started with an investment total of 24,000, you can see how the graphic goes up. And then by the age of 67, that person who invested at 21 has $471,358. The person who starts at age 47 with the same exact investment start in terms of assets only gets to 59,295. And all that is that it's a lack of time. Time is the number one weapon that we have, especially as early investors, in making sure that we allow compound interest to help our portfolios. So again, this is just a powerful graphic to show that don't prolong it. The earlier you start, the better off your outcomes are. Right now, this country has a massive need for savings. The average baby boomer only has about 275,000 in savings across retirement accounts or otherwise, and that's a major need for people to be able to put money away down the road. You're talking about some of these people living another 30 years and only having 275,000 in terms of savings. That doesn't allow for a lot of relief down the road, especially during troublesome times. So again, the earlier you start, the better off you are. And this graphic is assuming an 8% annual return, which is the historic return of the stock market over its lifetime. Bull and bear markets. I'm sure most of you have heard of these. They're debated all the time. Are we entering a bull market? Did we have a death cross on a chart? Are we now in a bear market? Where do we stand on the 200-day moving average? So what is a bull market? Prices of stocks are rising or expected to rise when investors have optimistic view of the economy, the markets, and near future. We've been in a bull market. We've been in the longest bull market in history. That got debased last March with COVID spreading across the world and a global pandemic shutting down businesses. Then we had the quickest bear market and the quickest recovery in history. So it's debated right now on which market we're in. A bear market's the exact opposite. The market experiences prolonged price decline. Security prices fall 20% or more from recent highs, and they're obviously negative investor sentiment. One of the good ways to kind of judge this is based off of the fear and greed index. So another Warren Buffett quote, one of the famous ones out there: I want to be fearful when others are greedy, and greedy when others are fearful. So being able to depict which type of market you are in is greatly going to help you down the road. But we are here to help. We're here to assist and answer these questions as they come about. In our opinion, we do think the market is overvalued. 20% seems like a far correction, but it could be healthy and bring out opportunities. How long does that bear market potentially last? Seems not for long, because right now we have the Fed as our backstop, and that has been in investors' minds since for the last, call it 10 or 12 years. We're continuing to buy $100 billion in bonds in a month. We're suppressing interest rates, and there's the opportunity of potential yield curve control, and aligning with the short end of the curve could be helpful. But we think that with any danger that the market may face, that the Fed is going to continue to come to support it. But the real question remains is how many times can you hit the print money button with it continuing to work? It's starting to lag a little bit. So it's going to be interesting to see what occurs over the next 1 to 2 years, especially with inflationary expectations. Volatility, we touched on this a few minutes ago. We do think that, this could be the year that, the market makes volatility great again. Represents how large an asset's price swings around their average price. The higher the volatility, the riskier the security. Bitcoin kind of fits in that world right now. I'm sure a lot of people have crypto, front and center of their minds as it's become more widely adopted. But in our opinion, it's the most volatile asset class. Even if it is a store of value, correcting 20% or 30% in any given day is an extreme amount of volatility. So when you hear volatility, that's why you want to be diversified. You want to limit that downside risk as much as possible when things get ugly, because more often than not, when things do get hairy, investors tend to throw the baby out with the bathwater. So having volatility is obviously going to hurt your portfolio, but that's why diversification there is to uplift it and protect from major downsides. So when the stock market rises and falls the more than 1% over a sustained period of time, it's called a volatile market. We do think that right now we're in a period of summer lull. Those of you who have read our market outlooks, that continues to be our theme. But we do believe that once we get to September, October, and towards the end of the year, based off of we expect inflationary expectations to be, that potentially the Fed could be behind the curve, investor portfolios are not prepared, and the volatility rears its ugly head around towards the latter end of this year. And last but not least, we are here to help. We're here to answer any questions that you guys might have regarding the markets, your 401ks, outside accounts, or even just managing your student loan payments, looking at mortgages and being a first-time home buyer. We have a number of resources here. We have 6 certified financial planners on staff. We're a team of about 18 folks, and we're here to address any of the questions that you potentially might have. So please reach out. You'll see my contact information directly below my photo. And those of you who receive our newsletters can just click directly through the link to get to our website. You can go ahead and book a certified financial planning session with any of our planners for 20 to 30 minutes, whatever time you need at a time that's convenient for you. So we really hope that folks take us up on this. We do think that, after a great decade of run in stocks, that things could be, percolating in a negative direction. So I think that if we can get you guys prepared, the better off we all are now and in the future. So with that in mind, we will leave you. We'll let you get on with your busy days. Thank you for joining us today. And we look forward to connecting with you guys individually in short order. Be well, take care, and enjoy the weekend, and happy 4th of July. Hopefully you guys get some time off and enjoy the summer that just started. Take care.